been watching the markets, I hope, intently for us.
Oh, yes.
A bit of negativity that's come through today, apart from a few stocks that are sitting in positive territory. And interesting, we've got Tiger Brands up around 1.4%, Vodacom also sitting in positive territory, and no real movement on the industrial sector front.
Yeah.
So it seems that negativity there. Financials did a bit better, even though industrial sitting at the top of the top 40 today.
Yeah, look, financials came through towards the end of the day. I mean, they were slightly down, most of them, I think, for most of the day. And then we saw Absa, for example, finishing slightly up, which is in stark contrast to what we saw last week, where we saw a really powerful performance from the likes of Absa in the first round, for example. But you're right. I mean, companies like Tiger Brands, you know, it's always seen as being a fairly defensive type of counter. And of course, Vodacom, I mean, that pays a very, very nice chunky dividend these days. So I suspect in a market like this, where there's no particular clear direction coming through, people are looking for good dividend payers, good defensive stocks.
Okay, so we've also got Sanlam sitting around up 1.4%. We've also got Old Mutual up almost 1%. These two companies set to release results this week. What are you expecting on that front, Chris?
Yeah, look, we've had trading update from the Old Mutual. Well, I think we've got a pretty good idea what's coming out of that one. I think the Old Mutual, you know, it's a company that you know, was listed in 1999. It's gone through some real trauma of its own, but it looks to us like things are starting to come right. It's a streamlined version of what we saw even a few years ago. I think they've learned their lessons in terms of a lot of their foreign acquisitions. Things looking an awful lot better. Sanlam, again, you know, has been it's been a remarkable performer in the sense that it's been a very good sustainable performer. Nothing to shoot the lights out, but you know, good solid stuff.
Let's also touch on MTN with regards to the trading updates. Looking good. Earnings per share basis up around 42%.
That one blew us out of the water. I mean, because we were looking at this thing coming in with kind of low to middle single digit kind of growth. To come in that kind of growth really was quite phenomenal, and particularly against the backdrop of the problems which they've experienced in Nigeria and Iran and Syria and places like that. So this really is, I think, is confounding.
MTN is down around 1% though today.
Say again, sorry?
MTN is down 1% though.
Yeah, I know. Well, the trading update came out on Friday.
Yeah.
You know, so I think a lot of people have been able to digest what's going on. But even so, you know, I think a lot of those Iranian concerns still weighing on MTN there, even although the earnings are going to be very, very good.
And of course, we had Iran, we had those issues there, and we also had Nigerian issues as well.
Yes.
So it seems it was sort of like a double blow for MTN, but still very strong. I mean, it's operating in 22 African countries and Middle Eastern countries as well. So very large geographical footprint, enough for it to be a buy for you, because Vodacom is at the second best performing stock today. It's up 1.4%. Vodacom versus MTN. Yeah,
and this has been going on for a while. We've had a good look at both of these stocks. We have MTN in our portfolio as a co-holding. We've had it for a long time. And we've debated the possibility of doing a switch into Vodacom. At the crux of the matter is the problems inherent in some of those jurisdictions that I've just mentioned. But as you rightly say, it's represented in many, many other countries in Africa and beyond, and it's never let us down in the past. Whereas Vodacom is less of, it's got a far smaller footprint. Having said that, within South Africa, you know, on the data side particularly, going very, very nicely indeed. So there are two companies working in the same kind of space, and yet with very, very different dynamics, pushing both of them.
So let's touch on the resource counters. We've got Anglo down 1.4%, Anglo Gold shedding ground. Goldfields at the bottom of the top 40, down around 3%. We're seeing the overall commodity basket under pressure, and this is because of the concerns of slow growth out of China. 7.5% is what the country is expecting for 2012.
Two things I think we've got to bear in mind here. One is that when the Chinese have this wonderful ability that when they come out with these growth targets, they usually surpass them.
So they always come in conservatively.
Yeah, they do. And there's another thing we've got to bear in mind, that they have to have at least 7.5% growth. That's a kind of ballpark figure, because if you don't have that, they do run the risk in certain parts of China of enduring civil insurrection. But over and above that, we have to also bear in mind that China is now in what I'd call the third phase of expansion. We've had the export growth, we've had the massive infrastructure side of things.
So now it's focused on the
consumer. Having said that, consumer growth isn't necessarily a bad thing for commodities. At the end of the day, consumers buy goods that are made. Now, where are these going to be made? Sure, they sure ain't going to be made in the developed world. They're going to be made in China and India and other parts of Far East Asia. So, there's still going to be a demand for commodities. It might not be at the intensity that we've seen in recent years, but it's still going to be there.
How do you then foresee the overall outlook for the resource space? Because for some time now we've been saying resource companies are looking so cheap relative to what we see in the industrial space, but we know that resources are also very much exposed to what we see on a global level, and again, ructions occurring in China.
Yeah, look, it does come back to valuations, and if we take Anglo as a very, very good proxy for this, Anglo is still sitting on a very, very cheap PE, eight and a half PE or thereabouts. It's not expensive by any stretch of the imagination. And even although demand for the commodities, and I'm thinking of iron ore here particularly, might not be as robust over a 2-3 year view as it was prior to that, it's still going to be high.
Let's touch on Sasol. It's sitting at 403 Rand. It's down around 0.6%. This oil price is shooting the lights out, Chris.
It's amazing, isn't it? And while I accept that Sasol is probably more sensitive to the Rand-dollar exchange rate, and we have got a relatively strong Rand compared to what it was even a few months ago, the Sasol share price, in my opinion, is conveniently ignoring the very high dollar oil price, which may even go higher in the next few weeks, depending on what happens as far as conflict in the Middle East is concerned. So I think the Sasol, we've got a price target of somewhere in that 475 to 500
and it's unbelievable, because we were talking about this last year when we saw the oil price edging up above $100 a barrel, and saying, whether the global economy would be able to sustain oil prices at these levels. When do we then teeter on demand destruction?
I think we're getting close to that sort of figure. I'd be very surprised to see us going back through the previous peak of $147, which we saw in 2008. Because as you rightly say, as you get into this kind of mid-120s level, you start getting demand starting to taper off a bit, because people get a little bit circumspect about what they're prepared to pay for oil. But I think we've got perhaps the prospect of a little bit further. Look, it really depends what you mean about the Middle East. If we get a full-blown confrontation between Israel and Iran, then all bets are off, and then you could see this price spiking significantly, even from current levels.
Where would you want to be right now in the equity market, Chris?
I think still very much with an overexposure to resources. We still very much believe in the super cycle, the commodity super cycle. You've mentioned Sasol, very much into there.
Would you buy even at a 403 Rand a share?
Yep, because we have a price target significantly north of this.
And
level.
what is the price target on that?
Somewhere in that 470 to 500 range. It's and even without the share price doing significantly better than where it currently is.
Let's also just touch on what we've been seeing within the banking space, and you mentioned that a little earlier. Is it time now to also be in banks? Because we've seen banks running up quite nicely. Some say time to take a bit of profits and lighten up.
Some of them have run very nicely, and if you're a trader, maybe some of these things are looking quite juicy now. But bear in mind also that certain of these shares, and I'm thinking of Absa particularly here, are paying very, very attractive dividends. We're looking at Absa now on a dividend yield of 4.3%, and all the research that I've seen suggests that dividend yield, all other things being equal, is going to improve even more over the next 2 or 3 years. So if you're looking for good dividend plays with a degree of safety built in, I think they're still looking very, very good indeed.